The principles for the recognition, measurement, presentation, and disclosure of financial instruments are dealt with in 3 standards, namely IAS 32 Financial Instruments Presentation, IFRS 9 Financial Instruments, and IFRS 7 Financial Instruments Disclosure. On the Statement of Financial Position, new items will be explored. Under assets, both non-current and current assets, we now have a new line item representing financial assets. Under non-current financial assets, new categories such as at fair value through OCI and at amortized cost will be introduced. Under current assets, you will come across items such as cash and cash equivalents, loans, trade debtors, and at fair value through profit or loss. Some of these items are familiar, some are new. Under liabilities, non-current liabilities as well as current liabilities, there is a new line item representing financial liabilities. Categories under these items include at amortized cost and at fair value through profit or loss. Which other components of the financial statements will be affected? In your statement of profit or loss and other comprehensive income, you'll come across items such as dividends, interest, fair value adjustments, both through profit or loss and OCI, as well as profit or loss on sale transactions. What is a financial instrument? A financial instrument is any contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. It is evident from this definition that 3 elements need to be present before a financial instrument can exist, namely a contract, a financial asset, and a financial liability or an equity instrument. In terms of IFRS 9, a contract is an agreement between 2 or more parties which has clear economic consequences that the parties have little, if any, discretion to avoid, because the agreement is enforceable by law. However, it is not a requirement for the contract to be in writing. Financial asset. A financial asset is either cash, an equity instrument of another entity, the contractual right to receive cash or another financial asset, or the contractual right to exchange financial instrument under favorable conditions. Examples include currency held in a safe, investment in ordinary shares, debtors, and a purchased option. A financial liability is a contractual obligation to deliver cash or another financial asset, for example, trade payables, or the contractual obligation to exchange financial instruments under unfavorable conditions, example, a written option. An equity instrument is a contract that evidences as a residual interest in the assets of an entity after deducting all its liabilities. This is a familiar concept coming from the accounting equation. In summary, financial instruments, we will again focus on recognition, measurement, and to a lesser extent, disclosure. Under recognition, again, initial and subsequent, as well as under measurement, initial and subsequent measurement.